schedule it from 5 to 7. So once again, thank you so much for joining this class. I'm not sure how many of you were there in the last class. Like I am pretty sure Bhavna was there. Manish, I think, was there, if I'm not wrong. So few students may not be there because I think time is bit different now from the regular time. And so anyway, we'll before wasting the time, we'll start this class. So in the last class we were discussing actually, so I'll just give you a brief recap in just 1 minute and then we can start with so you can understand what is happening. So the chat unit was all about volatility, default risk and all, purchasing power risk and all. So it started with the volatility and then what is volatility and how, what is high volatility and low volatility. Then we discussed about bond price volatility and then what is happening currently, where I showed a screenshot of Indian volatility, what is happening recently, and we did a comparison with US, where US it is highly volatile. The bond market is right now. In India, it is actually volatility is low, and it is a bit surprising because there are so many factors that investors or regulators are assuming that market will be stable, the government may continue, so there would be slight stability in the market. So they are a bit confident about Indian scenario. Now then we discussed about how do we measure volatility through standard deviation and variance. And first of all, just a second. I'm sorry, I'll share my screen also. Uh, just let me share my screen. And one of you just confirm once it is done. Okay. Is it visible now?
Yes, sir.
Yeah. So we discussed about how to measure this volatility through standard deviation and variance, and I showed you this. Why do this is happening? I don't know. Just just a minute. Yeah, so we discussed about this question also, where we solved how to do this historical volatility measure about bond price and all on a monthly basis and annual basis. Then we discussed about interest rate risk, how to measure interest rate risk, what are the consequences and all. Then what are the implications of this? And then how do we measure this interest rate risk? So I said we have three broad parameters or broad methods through which we can measure this interest rate risk. Like we have duration, which we have already discussed in detail so far. Then we had gap analysis and value at risk. So today, gap analysis also I showed one example last in the last class. Today also I will show one more example about gap analysis. Then we will discuss about value at risk, which is one of the highly important concept in the especially in the area of fixed income market and financial risk and management. You must have heard it when you must be taking the course called financial risk and management and all, if it is there in the school of open learning. That is one of the most important subject, comes under quantitative finance or quant finance. Okay, so one example I discussed about gap analysis. So where I said that in gap analysis, you generally measures the liabilities along with its assets based on different maturities. And then you see if the liabilities are higher or assets are higher, because interest rate risk might be there. So suppose liabilities are more, it means you have to pay more interest in case of interest is rising. Then you have to pay more interest and it will be a cost on the balance sheet for you, especially if you are a banking sector, if you are in the banking sector, you are a finance company and all. Similarly, if assets are higher and interest rates goes up, so it would be beneficial for you because depositors, sorry, because the person you are giving loan and all, you will have to, you will get more interest and that would be an income for you, because generally this is the main source of income for the banking sector. The interest they charge and the interest the difference between interest they charge and the interest they paid. Okay, so through which we did some gap analysis. How do we do? So I just showed a very simple numerical example where one side it was assets and liabilities, and we saw that total asset is 100, where total liabilities right now it is 65. Though assets should be equal to liability. This is for an example purpose. So where I told that if total assets are higher, it means the bank is in a profitable situation because in case of interest goes up, but in case of interest goes down, reverse would be the case. Now, one more example we will discuss is, suppose this is the scenario where suppose a bank has the following assets and liabilities. So they have different loan and different maturity in even under assets. They have provided fixed rate loans maturing in 1 year, which is 100 million, then which is maturing in 3 years are 200 millions, and then 150 loans are being matured in 5 years. Similarly, they have certain liabilities where they have 250 million liabilities maturing in 6 months, and then they have 150 millions which are being matured in 2 years. So there are certain steps to do actually gap analysis. You have to remember these steps. If they comes into your exam, you can take right now the screenshot also. That's how you will go ahead with the with measuring this assets and liabilities and do this gap analysis. So first step is you have to schedule these assets and liabilities in a appropriate time manners, and then how many like based on the time frame, like 1 to 2 year, 2 to 5 year, 5 to 10 years, and all in that sequence you have to keep. And then you what will you do? You will try to calculate the cumulative gap for each time bucket by summing the gaps from previous time buckets. I will show an Excel example also. And then you try to measure what is the interest rate exposure for that for the bank. Okay, so how will you do it? You can see one simple Excel example. The same I have put it here. So for example, that's how you will put all the time series here: 0 to 6 months, 6 months to 1 year, 1 to 2, 2 to 3, 3 to 4, 4 to 4, 5. Then in one column you will keep assets. Assets is one for 0 to 6 months they have 100 million, and then in between they don't have any. 2 to 3 years they have 200 million. Then 3 to 4 they don't have any, and 4 to 5 years they have 150. Okay, coming to the liability side, they have 250 million in 0 to 6, then 0, then 1 to 2 they have 150, then 2 to 3 year they don't have any, then they don't have any, and then they don't have any. Okay, coming to the gap, what will you do? In assets minus liabilities, you will have 150 more liabilities you have more than assets. Then in second year you don't have any. Then 1 to 2 years you have liabilities again. So you have 150 million dollars liability. Then you have again assets, but you don't have any liabilities. So difference would be 200 directly. Then again you don't have neither liability nor assets here. Then again you have in the 4 to 5 years you have only assets, no liability. So your gap would be 150 positive because you have more assets than liability. Cumulative gap here it would become 150. From 150 it would be 150 in 6 months to 1 year. Then it will become 300 because again you have 150 liability. Then you have it will become less because this time you have assets also, and when you will do it accumulation it will be 100 million only because 100 million extra you have assets. And then it will become minus 100 million because there is nothing into 3 to 4 years, and finally you have only assets of 150 million, and then your cumulative gap would be 50 million, that is positive. So in that case, if suddenly interest rate is increasing, that would be beneficial for the bank, and if interest rate goes down it would be like a burden on their pocket because they have to pay more interest. So this is just a simple example of gap analysis. That's how bank do actually. Now coming to another most important topic right now. So that with this gap analysis I'm closing, and now we are moving to another concept, another method, which is called value at risk. So this is, please understand, if you are applying into in the finance domain, you are going in the risk analysis profile, or you want to be the data analyst and all in the area of finance and quant finance. These kind of methodology and these kind of terms you need to know, and then they are very basic in the finance, but most important for the companies, for the banking sectors and all. So value at risk, what does it actually meaning? So if you read the definition here, it's a statistical measure that estimates the potential loss that an investor or portfolio may experience over a given time period at a specific confidence level. If you did not get it, just read the second thing, which I made a little bit simple. So in simple way, what answer the question, what is the maximum amount of money I could lose on my investment or portfolio over a certain period with a certain level of confidence. So it tells you the maximum loss you can incur on your investment. The maximum. So that's why we call it downside risk measure also, because it measures the downside of it, like how much or maximum loss you can have on a given portfolio, on a given having a certain amount in your pocket. That amount, if you have invested, what could be the maximum loss you can bear or you can have in a given time frame, and with a certain percentage of confidence or probability. Okay, if you did not get it, again read the example also. For example, if the value at risk for a portfolio is $1 lakh at a 95% confidence level over a 1 month period, it means that there is a 5% chance. How 5%? 1 minus 0.95. 5% chance that the portfolio could lose more than 1 lakh in value over the next month. Or you can reinterpret it like there are 95% of the time your loss will be limited up to 1 lakh only. Only 5% chances are there that your loss may cross that limit. It may go above 1 lakh. Okay, so that how VAR helps you in managing the downside risk. Okay, so that is the simple definition of VAR. Now, you need to understand there are certain components of value at risk. And these components you need to understand before you delve into this VAR, the definition, their calculation, measurement, and all. So VAR has these following components. For example, first is time horizon. The time horizon is the period over which the potential loss is measured. Like for how many days you want to see, like you want to see in 1 day or in 10 days or in a month or in a year. So most commons are 1 day, 10 days or 1 month. And that's how you try to measure how much loss you can incur given in this a specific time frame. The second component of VAR is your confidence level. Confidence level, or here you can, for easy terms, you can understand what is the probability, or what, how much confidence you have, or what, with what confidence you want to measure this probably this loss associated with the war. Okay, what confidence level you want to have. So generally we say we want to be 95% sure confidence level, or we want to measure it at a 99% confidence level. More conservative, like you just want to take 1% risk. Okay, I just, because 100% cannot be there, and there is nothing called 100% in the area of, in statistics. That's why it's statistic, it's not math completely. So you cannot say that 100% you can say. When probability comes, it is not it is probability, it's not surety. So you cannot call it 100%. Correct. So generally you want to measure either it at 99% level, or you want to measure it at 95% level. These are the most common level. And if you are more liberal, you say, okay, let's see even 80%, okay, you can see 70%, you can see, I'm willing to take 30% risk and all. These also you can go ahead with. And there are different ways to calculate this. Okay. The third component of the value at risk is portfolio value or investment amount. The amount with which you are playing with, the amount you have invested in the market, or the market value of that investment right now in the market. Because with that only you want to see the exposure. Now, see, I have 1 lakh rupees invested into stock market and all, and I want to see with this 1 lakh how much I may lose, how much money I may lose. So that's is your investment amount you want to measure around. Then the fourth thing, you have to see the market data. You have to take the historical data. You want to see the trend. You want to see different risk factor. Or in any case where you are measuring this war, are you measuring war in the context of stock market, in the context of interest rate, or the exchange rates, or the commodity prices? This depends upon the assets in the portfolio. You may have war for the overall portfolio also, or you may measure war for your individual security also. But for anything you have to compute data, you have to download or collect the data for a historical period, like for 5 years, 10 years, whatever, is up to you. You have to take certain data, and then you have to play around with this data to calculate a meaningful calculation from the data. Then the fifth component is volatility and correlation data. So volatility, in the last class also we discussed how to calculate the volatility. This is nothing but the measure of risk or uncertainty in the market through standard deviation. And we went step by step how to calculate the standard deviation or the volatility or historical volatility of the data. that we discussed in the last class. And also you want to calculate the correlation between different assets in the portfolio. So if you are measuring the value at risk in the portfolio, you have to see the correlation among assets also. Then you have then you have once you have done with all these things, you will pick up a methodology. You will pick up a methodology how to calculate this war. It could be historical volatility at value at risk. You may approach variance covariance method or simulation method, particularly Monte Carlo simulation. So VAR has a property. It assumes that the data is normally distributed. I don't know how many of you might have heard this in statistics. Like when we say the data is normally distributed, we see that 50% of the data lies one side of the mean and 50% of the data lie another side of the mean. And that's why it's take the bell-shaped curve. So this is the very important assumption under VAR. It assumes that data is normally distributed. Whatever VAR you are calculating for, you risk, interest and all, it is normally distributed. Okay, if it is not normally distributed, the simple war cannot be applied, and then you have to approach this simulation method, Monte Carlo simulation method. Then we have Coppola method. We have other advanced machine learning or highly quant methods and all. For that, you have to have understanding non-parametric methodology. What are the non-parametric tests you can apply for, or how can you transform the data in certain way to make the data in a normally distributed shape? That is a different assumptions under war. But don't get panic because I'm not going to discuss those things right now. Otherwise, you may not get it. We will try to take a safer route and how can we understand war in more simple manner without making things more complicated. Okay, so I'm not going to uh, discuss so many things. Okay, this is happening and this is bootstrapping or simulation, Monte Carlo simulation, because you need high coding, programming things and all for that. So we will try to approach more simpler route to understand things much better. So before we go into the next concept, why don't we try just to how to calculate this war? Now, what will I do? I will try to we will start from the scratch, like from the first step, and then we'll see how can we calculate the value at risk. So for that, what will I do? I will tell you each and everything, like how can we go ahead with the data. We will download some data, then we will arrange the data, then we will calculate all the steps, and then we will calculate this value at risk. Okay, so let's see how can we do that. So suppose you want to download the data first. Mm, what can we do? Any site you can take. So for me, you can take NSC or BSc, but if you want to take the data for different countries and all, this is my favorite site. I generally go ahead with this site. This is investing.com. Okay, so they may not give me some data because I have applied already ad broker somewhere something, but I will try to see. So here, this is very interesting website. Actually, you can get minimum data for all the countries for different indices, for bond yields, for government bond spread, uh, commodity prices and all. You can get some data from here. And this is actually this is mostly free because they are advertisement based website. So this is mostly free. You have to create your account and then you can take data. So for example, here you can take indices data, stock data, commodities, cryptocurrency, currencies, ETF fund, bonds, certificates. So where do you want to go? So war is actually here we will try to measure it with the stock market only because the data is very consistent and everyday trading data you can get. Then we may see how can we do it with the bond also. So suppose you take the data and I'll tell you it's very interesting. You can take so suppose there's I'll try to take data for okay, take indices data. In indices you can take futures, major indices, so world indices. So here you can get data for all the uh, major indices or across the world. Okay, so you can select your countries, America, Europe, Middle East, Asia Pacific. Suppose you want to go for Asia Pacific, then all Asia Pacific, you can again filter it out. Okay, I want to take for India, you want major indices, additional indices, primary indices also you can take, other indices you can take, and you can search. So if you see, we don't have only one Nifty, BSC and Sensex only. See, we have that many indices. So you will have the list here. You have BSC, Nifty Mid Cap, Nifty 50, BSC All Cap, Small Cap, Mid Cap, BSC 500, 200, BSC 100, small, cap, Nifty 200, Nifty small. So all this data you can get. You can get even banking sector data also. You can directly get volatility index data also. Okay. Then suppose what is our favorite one is Nifty 50 because that we hear a lot in the newspaper and all. Let's go ahead with the Nifty 50 only. In Nifty 50 only, here you can see what was the closing price today. It was this. Nifty was closed at this price. It was slight positive today. And you can see the chart also here. So you can see now recently we are in the news also that market is performing very well. You see the jump from here and you see in recently how much jump we have seen in the market. Okay, so that is different thing. Now, what do you want to do? You want to calculate the war. So you need historical data for that. And there is a link here for historical data also. So you can see, okay, I want to calculate some historical data. Historical data, suppose you want to take daily data. Okay, fine. Here you can fix the date from where you want to take the data. So I want to take data, suppose let's stay for last 1.5 year. So January 1st I can do and let it be today only and just apply. So it will give you the data for the, it is giving you the data. What can you do? You can just download this data from here. Okay. So data has been downloaded. It is open. So it is in CV file. What will I do? I'll try to take it into my the sheet where I'm trying to solve other things also. So this is volatility analysis sheet. Okay, I calculated already. Yeah. Okay. Sorry, war analysis. Yeah. So here we can paste it. Okay. So actually I wanted to do it from 2023 to 2024. And it is so not no worry. We can do one more thing. And this date is also not very consistent. So you want to do it from 2023 to 2024, then you can do one thing. No, this is not paste special. I'll just add one more column here and just suppose you now want to put it serial number 1, 2, and that's how you can just double click. So now what can you do? Just go to sort, custom sort, with which you want to sort it out. You want to sort it out with serial number, the smallest to largest and largest to smallest, and then you can do it. So now you can see the data is in this sequence only from 2023 to 2024. You can delete this also. One more thing I want to tell you here, you will take only price, open price, high price, low price. We generally don't take. We take closing price here. This is the closing price. So the first step in the volatility analysis is first you have to calculate the return. So this is return. If you see the return, they have already given the change. But if you want to do by yourself also, you can do like this. So as I told you, the return formula is P1 minus P0 divide by P0. And that's how you will see. It is almost, this is exactly same. Okay, so same. This is your return. Okay. And then after this, the second step would be you have to calculate the variance, covariance, and volatility the same way we did in the last class. So what will
Excuse me,
you
sir.
do? Yes.
Sir, can you repeat the return?
Sorry.
Can you repeat the return?
Can I repeat the
Return
return?
portion.
Acha,
Return
return
portion.
portion.
Calculate.
It's nothing. It's P1 minus. I'll show you. Wait. It's nothing. It's like P1 minus P0 divided by P0. So what is the return compared to yesterday's today? Okay, so you have to like from one in this data three from 1
Current
3
price
20
minus
20.
previous price upon previous price.
Current price minus previous price divided by previous price. Okay,
Okay, right.
so got it? Shall we proceed?
Yes, sir.
Let me just grab my mouse. Just give me 1 second. It's taking a bit time. Give me 2 minutes time. Okay. Okay, got it. So where were we? Okay. So the first step is done. Then we will calculate the variance, standard deviation, and then finally we will calculate the VAR calculation. But if you remember in the theory when we were discussing, I told that VAR has certain other components also. Like you have to see the time horizon, you have to see the confidence level, you have to see the Z value. Z value, I'll tell you what is Z value. So now you have to set a confidence level. First, to set the horizon for how many days you want to see. So suppose your time horizon is 30 days. Okay, fine. Then second thing, you need confidence level. What confidence level you want to be sure with? You want, okay, I want 95% of the time my data should be or my return should be good. Sorry, 95% of the time it should not cross the certain percentage of loss. Once you have set the confidence level, based on this confidence level, there is a concept called Z value. What is Z value actually? It is the standardized form of normal distribution, which I was discussing. So one Z value you have to calculate here based on this probability or the confidence level, 95% level. It is nothing. Either you can go in the backside of your book and they must have a table, the probability table or Z value table. For normal distribution, you will find what is the Z value for 95% of the confidence. They will tell you. Or if you have Excel, is a simple formula called, I think, if I remember, norm SINV. Okay. This will ask what is the probability. Your probability is 95%. And this is your Z value. If you go and measure, check in the book also, it would be around 1.65 only. Okay. Once your Z value is done, your second job is come. Let's start with calculating first the volatility. So if you remember in the last class also, I told the volatility in the case of volatility, you have to first calculate the mean return. Okay. So what is mean return? Mean return is nothing but average of your return from here till here. So okay, you have, oh, 0. Then definitely it would be so many decimal points. Ah, yes, here. Okay. Once your mean is done, the second option will be you have to calculate the variance. And what was the thing I told in the variance? So for variance, you have to first calculate the mean return minus the daily return. Okay. So the mean return is, sorry, it is ulta. I'm actually sorry. The daily return minus the mean. Sorry. Okay. So what is the daily return here? Your daily return is this, it would be 0. Then your mean return is this. Okay. This is the value you got. And same thing you will apply for others. But before that, you want to keep the mean as fixed. So do one thing. You put this dollar sign here. You put this dollar sign here. And then do it. And what will happen? The mean will be constant across the series. It would be n8 only. And daily observation minus this. You will calculate the mean. Okay. Can do one more thing. We can reduce some decimal points to make the calculation easy. Okay. Okay. Till here we can do. Okay. Now the second thing will come in that this thing you have to square this deviation. Okay. So I told you either you can just simply step this multiplied by again this. Either you can do this or you can do just simple power. What power? This number ki power kitni power? 2. And then you just enter. Same thing you will get. Okay. And this you can repeat it till here. Okay. If you remember what I told you that that variance is nothing, but what will you do? It is the sum of your square deviation. Okay. Then you can divide it by the number of observations. Sorry, I forgot the number of 330. So it should be 329. The number of observation is 329. So 329 is the number of observation. This is your variance. Okay. And what is standard deviation then? STD deviation. Standard deviation is nothing but square root of this number of your variance, and you will get your standard deviation also. And this is called your volatility also. So this is the manual process. Otherwise, you can do this thing also. Suppose you want to calculate the variance, sorry, per dot P. Suppose you want to calculate their daily return variance. I'm pretty sure it should be same. If something is wrong, then it's same. But in the exam, you may not get all these things, laptop and all. I don't know whether they are giving. So you can directly calculate standard deviation also. Just directly go daily return. Sorry, this, this, this. What happened? Why it is not coming? Hmm. Okay, it is same only.
सर ये वाला पार्ट रिपीट करेंगे, समझ में नहीं आया।
एक सेकंड क्या मेरा थोड़ा कम सुनाई दे रहा है? हाँ बताओ क्या करना है?
ये लास्ट वाला पार्ट जो डेज की बेसिस पे आपने स्टैंडर्ड डेविएशन किया।
इसको फिर से रिपीट करना है?
हाँ जी।
हाँ चलो देखो फिर से देखो। वैसे रिकॉर्ड हो रहा है क्या ये? हाँ हो रहा है। तो मैं दिखाता हूँ आपको फिर भी। देखो इसके सिंपल स्टेप्स है, यू हैव टू सी सम स्टेप्स। फर्स्ट व्हाट डिड वी डू? ओके मैं फिर से बताता हूँ वन मोर टाइम सो everybody will learn. First we calculated the return. You know how did we calculated the return? Current price minus previous price divided by previous price. Okay, that's how did we throughout the series. In the second step we calculated this mean. That was our second step. How did we calculate the mean? We just took the average of the return. ठीक है? This is step number 2. Then in the third step, what did you do? You calculated this daily return minus mean return. Okay, so you wanted to see the deviation of the daily return from its mean. That is one essential step when you are heading towards calculating volatility, or you are heading towards this calculation of value at risk. Okay, the third step was this only. Just a second. A second. This was your first step, right? This was the second is done. This was your third step. Okay, then what did you do? You calculated this square deviation also. What is square deviation? Is nothing but the deviation you calculated का square root कर देना है, power by 2 or just multiply by the same value. Okay, this was your fourth step. Once you had this square deviation, you will calculate the variance. So what is variance? Variance is actually average of square deviation. Okay, and that was your fifth step, where you took the summation of entire square deviation and divided it by the number of observations. Okay, based on that you calculated the standard deviation. Standard deviation is nothing. Whenever we say word standard, just consider it a standard form of something. So standard deviation is nothing but the standardized form of variance. So we standardize variance. How did we do that? We just took the square root of variance. Okay, and that was our sixth step. So this topic has covered two things. It has also covered your previous exam, how to calculate the volatility. Till here you have calculated the volatility. Okay, now the question is, what will you do? Standard deviation is there and you have your Z value is there. Now you will calculate value at risk or your VAR. Okay, how will you calculate the value? It's just simple. You multiplied your standard deviation with the confidence value you got, and this is your standard deviation. Oh, sorry, value at risk. If you convert it into percentage form, this would be your percentage form. Okay, so the value at risk value is 1.056%. Okay, in simple term, how to interpret this? Suppose you went in the market with 1 lakh rupees. Okay, you want to see, and time horizon also you have 30 days, but sorry, this is your daily value at risk, but you want to see for 30 days. Again, you have to do nothing. you have to just multiply your daily. Okay, I can write down this. Your daily var multiplied by with square root of number of days. So your daily war now your what would be your 30 days war would be nothing. You just multiplied it with the square root of square root of 30 days, and that's how this is your 5.785% is your 30 days value at risk. So in a 30 days time period, suppose you have invested 1 lakh, you want to see what would be the maximum loss you can have. So the maximum loss would be nothing but, sorry, into 5,785. So 95% of the time, your loss will be limited to 5,785. If you have invested 1 lakh rupees, your loss may reach to 5,785 rupees, and that too with a 95% confidence level. That would be your value at risk in the form of money, actual money you will lose. Okay. Or you can do this like this wrap text. Hi, cool. Okay, this would be your maximum loss. It made it look bit ugly. Okay, yo, no, then leave it. ठीक है. Shall I repeat all the steps again? Please, any one of you will confirm. I'll go with one person only. I'll not wait for the majority. Just tell me.
Okay, sir.
Huh?
Okay.
Shall I repeat?
Now,
Okay, now. ठीक है. Okay. So value at risk concept is clear now here. Now what you are saying, sir, you are talking about stock market return. But what we are studying here bond market, fixed income market. What about that? We want to measure the interest rate risk. We want to measure the value at risk for the interest rate. How will we do that? Nothing. Same formula, same thing you have to do. Just interpretation would be different. I'll tell you how to download this data also. You might find it boring, but I'll tell you guys, if you are in the data things and all, it is sometimes fun also how to do this data things and all. Okay, I'm not able to find where I should go, so I can just type also bond yield. Okay, bond yield they have, or you want to take Indian bond yield, then you can say 10 years IND India bond yield. nahi? Oh, they don't have. Oh, India bond yields. Oh, they don't have. Oh, that is not possible. I myself downloaded so many times. Okay, India 10. India 10 years bonded. Okay, you can see this also. Same step. I want to see the historical data. See, by the way, see the bonded, what is happening with India bond. Let's go. Okay, then you want to see the data from, let's say again, the same time period, or you can take more time also. You can take from January 2022. Why it is Sunday? Okay, Sunday. Okay, same thing. You can download it here. You can go and see the value here. Same, this is the yield data. Instead, this don't think it's price, the yield data. So in 2024, the 10-year government bond was offering you 7.159%. The interest itself is 6% in the market. So anyway, your money will be saved. You will earn 1% extra on your above the inflation. Okay. So the same thing you have to do here also. Again, it is just in reverse format. You have to take this data from here. Suppose, array, yeah, same steps boring. Okay. Uh, that's the advantage, but sometimes you download it from BSC, they will not do this. They will give you in the required format. SN smallest to largest. I want to do largest to smallest. Okay, the date in anyway we are interested with these two value only. Take these here and go with your yield curve, VAR analysis model. So just do one thing. Instead of this, you put the value here actually. Okay. And once you put the value here, all these steps would be same. You have to calculate the return for this thing. So mm, these things are there and you have to repeat the
सर
same
हमने रिटर्न
steps.
सर हमने
Sorry,
रिटर्न कैसे निकाली थी?
return बोला ना भाई P1 minus P0 divided by
ओके
P0
ओके
price
ओके
current
ठीक है
price
सर,
previous price divided by previous price.
ठीक है सर।
और डू वन थिंग, एक और काम कर सकते हैं, एक शॉर्टकट, इसको यहाँ से उठाओ और सीधा सॉरी यहाँ से उठाओ और सीधा इससे रिप्लेस कर दो. Everything will be changed. Oh, too much changed. Why it is so? Oh,
एवरेज
okay.
रिटर्न चेंज होगा ना?
Ah, sorry. Someone was saying something.
नो सर।
Ah, oh, formula got changed, but wait. I try to nothing. Formula changing. You have to put formula again. Okay. So see, one guy who was asking how did we calculate? We calculated it current price minus previous price divided by previous price. Okay. Oh, sorry. Sorry. Divide by previous price. Okay. Same formula you have to apply for everything. Everything is on the track now. Okay. That's how your daily return came. Then that's how your sorry, that's how your mean also might have came here. But instead of 331, this time it should be more actually. This time it should be more. It's 566. Okay. Remove this. I'm not interested in this now. How much is it? 566. 566. Okay. ठीक है. That's how you have calculated. But you have to change the number. Now instead of 331, we have 566. Everything would be same, and that's how you will calculate your value at risk or war. Okay. Do I need to do this or you guys got it?
सर एग्जाम में इसी तरह का क्वेश्चन आएगा न्यूमेरिकल?
Exam में बाबू I'm not sure it will come because इतनी लंबी calculation I would recommend won't come. But छोटा आ जाएगा. Suppose they may give you already calculated this mean, variance or standard deviation. They may give you all these things calculated, and then they may ask you calculate the what. Or they may give you mean and variance and will say how will you calculate the what. So what will you do? You will calculate standard deviation from variance, then you will calculate the value at risk from the standard deviation, and you have to interpret this. I'm pretty sure it may not that not sure. Definitely they will not give that lengthy. How will they give you the download the data and all unless you have Excel access and all? Okay. So this thing just try to understand it. It's understand it from job perspective also. This is very fun sometime. Exam perspective, I'm pretty sure they will not give you this. They will just give you mean value at risk. In fact, they may give you this question. Okay, this is the mean value. This is the invested amount. This is the time horizon. Calculate at 95%, or they may ask you to calculate at 99%. Okay, then you have to do what is the value at 99%. You have to see the table and also suppose you convert it into 99. Everything has changed. Okay, so they may ask you that at 99% you might have seen value at risk has increased. Why it has increased? Because at 95% level you are still being bit liberal, 5% chance you are willing to take. But 99% when you go, you want to be more accurate. What should be the case? So definitely they will say, okay, if you are that accurate, If I'm saying 100, मान लो it is 150 now. So they are also saying earlier it was 5,700. Assume it now 7,850 say. So what will happen in the exam? They will give you time horizon. They will give you confidence level. कि 90% पे or 95% पे try to calculate. Then they will the Z value you have to calculate, whether you have to see the, you may not have to calculate because tables will always be there, and you have to calculate your Z value based on the table, and then you have to calculate the value at risk. So you need to understand the steps. If how, what is the exact formula of value at risk? You have to calculate all these steps, and then you have to go ahead with this. This much data they will not give you in the exam. Okay, otherwise you will take two. How will you calculate without Excel? You will take minimum entire day to do this. Okay, this will not be your part of your exam. All right. Anyone else wants to understand anything from what? Any questions so far? Shall I proceed?
Yes, sir.
Okay, okay, fine. Who is this on hold? Is it your name on hold, or like, I don't know, why are you on hold? Oh, it's a name. Sorry. Okay. Then let's see. Now, finally, coming to the second concept of the day, this is called purchasing power risk. Okay. What is purchasing power risk? Is one of the very simple thing every day you the best thing you want to hear about. See, I'll tell you, it is very funny sometimes. You want to hear whether inflation is increasing or money value is going down. We talk so much fancy terms and all. You know who is the best person who has better understanding of inflation? Can anyone tell who's the best person in the world who has, not in the world, forget about the world, just think about India, especially the generation is 1990 to 2000. They may know who's the best person who knows about inflation more accurately in a well manner. Tell me. But they will not understand the word inflation, but they know the inflation in indirect way. Anyone else? Anyone? Can anyone tell you who is the best person who knows inflation more than we know, or without knowing this terminology, purchasing power parity, interest rate parity, purchasing power risk, inflation, GDP, consumer price index, wholesale price index, everything. That person knows much better than us. That person is our mother, or the one who run the house, a father also. They know, they will come in the evening and will tell you, see, today the grocery came for that amount. Last month, I remember, if you just call your mother and ask what is the rate of sugar, she will tell you the 10 historical rates of sugar. Last year it was 30, then 35. This month it became 38, and today I brought it for 40. She understands this very well. So they actually, inflation, when it becomes very heavy or it becomes very unbearable, is the household who can tell you when you are catching their nerves. Actually, they know what is happening in the market. They know, they will so many times mother tells, see, earlier I used to get this in 100 rupees, now in 100 rupees. क्या हो रहा है आजकल 100 rupees में? कुछ भी नहीं आता आजकल 100 rupees में. आजकल बच्चों को तो 50 rupees, he will not accept the 50 rupees. So that is called your purchasing power risk. The risk associated with your purchasing power, the volatility associated with your purchasing power, your power to purchase something, your power to purchase sugar, your power to purchase oil, your power to purchase any commodity you want to buy, your power to purchase scooty. The scooty also used to be at like 45,000, 50,000. Now you go ahead with the Activa or Jupiter 125, you'll get up to 1,10,000. That's called purchasing power risk. The risk associated with your purchasing power, the reducing power of your money. Okay. Why it happens? It happens because of inflation. What is inflation again? Inflation is the decreasing power of your money. Okay. It's the power of your money or the situation of money in the economy. Okay. In 1 unit of currency, in 1 rupees, what can you buy today and what can you buy it day after tomorrow? Okay, so that's how purchasing power risk works. First of all, it will show the loss of value. Okay, so suppose the rate of inflation is higher than the return on the investment you are investing in, or the interest rate you are going to get on your saving, it means your purchasing power is reducing. So suppose the inflation is 3%, 4%, or 5% per year. In case of 3%, your saving account is giving you only 1%. Your money is effectively losing its 2% of its purchasing power every year. So suppose you have invested 100 rupees in saving. That's why I was telling, no, you have to be very careful before investing. What can beat the inflation? Suppose bond is paying you 7.5%, you have to immediately see what is the situation of inflation in the economy. Oh, inflation is 6%. I can beat the inflation. At least my money will not lose its value. It will slightly gain in otherwise. Then you want to be more risky. Okay, I can go in the B, triple B rated. They will pay me 12%. I can go into just B rated. They will pay me 16%, but risk will increase at the same time. Okay, so inflation actually reduces the power of your money, losses, you lose the value of your money. Then the second is what will be the impact of investment? Obviously, your purchasing power risk will also affect your return on the investment. As I said, if your return cannot outpace the inflation, your real return will always go down like as the time passes. Okay, that is the sometimes that is the disadvantage of putting your money into saving account also, because saving accounts sometimes are not at par with the inflation. Now inflation is 6%. I don't know how much interest they are paying on the saving account, but that is your like day-to-day money, your circulation money you need every day time, and also you cannot afford putting each and every penny of your money into fixed deposit or into bonds and all. You need that money as well. Okay. Then third thing is most important, how it affects. That's why how it affects fixed income investment. And now this is important because you read the newspaper nowadays, everyone is talking about how this inflation is increasing and how it is affecting people's investment. In case of fixed income securities become more important because fixed income pays based on the interest rate. But if inflation rate is, as long as it is below the interest rate, nothing to worry about. But suddenly it start touching your interest rate or suddenly it outpaces it, then there's a concern for you. You may lose the value of your bond. Okay, that's how it is happening in US also. That's what was happening in India also. That's what is happening in UK also. So many countries is facing this increasing interest rate scenario. Why? Because countries across the world are trying to curb the inflation. And what is the best way to curb the inflation is to increase the interest rate. Because if interest rate will be increased, this people will not be willing to take more loan and all, or they may not be very interested in taking loan and all. Their purchasing power will go down and slowly the inflation will go down. Okay, but it may affect economic development also. That's why bank and monetary policy makers are very careful, because if it is goes too low, you may not have, especially in developing economies. In developing economies, you cannot imagine the zero inflation rate, because this is a situation where nothing is happening in the economy. Okay, because every time you need credit to boost investment, you need credit to construct the road, you need credit to like taking so many things now, farmer loans and all, how will you subsidize them and all, so many things you need. And so many things you need to take the loan and all, and that without that credit you cannot survive. Okay, that's how this inflation will always be there in emerging economies. We sometimes call it healthy inflation also, because if it is within the given range, it will actually boost the economy. But if it is too low or if it is too high, it works in the different directions. So that's why earlier Reserve Bank used to announce monetary policy, I think, on a quarter basis. Now they are announcing like bi-monthly and only for last 5 6 years, because you need to be very updated. Reserve Bank is always constantly worrying about the inflation rate, what is happening in the market, and that's why monetary policy and we all are looking what is happening, what rate they what how they are going to change repo rate this time. See, for me and you, it may not make much sense. We don't have that much money. But imagine the situation who's investing billions of dollars or millions of dollars. For them, even 0.05% makes a sense. Okay, for them it makes a sense. So that's why they are very aware about the ongoing interest rate scenario in the economy. Finally, it also affects your long-term financing planning. Like for example, if you are planning for your long-term financing and all, investors and savers need to ensure that returns again actually crosses the inflation to preserve or enhance their purchasing power over time. Okay, that is was about purchasing power risk. So let's assume there are multiple scenarios. For example, in 2024, you invest $10,000 in a 10-year corporate bond with a fixed annual coupon rate of 4%. You have planned to hold the bond until maturity in 2034. Your initial assumption is no prepayment risk. Bond is held to maturity, meaning you are buying bond today and you are not making redeeming it, and you will keep it till its maturity. Now, suppose there is low inflation and 10 years inflation rate is constant around 2% per year. You don't need to worry about it because your fixed income coupon rate is 4% already. You will anyway receive your 400, and that is much better than like 1% coupon rate or something, because your purchasing power will be constantly increasing and inflation is not going to eat that. Okay. But suppose what happens if the situation goes to 5%. If the interest goes to 5%, you will still receive the $400, but the value of this $400 has reduced because in that case, your inflation was 500 actually. Okay, it was 5%. So while you will get your 10,000 principal back and 4,000 in interest payment, the combined 14,000 will buy less than 10,000 did in 2024 due to inflation, because inflation has already eaten the purchasing power of your money. That is the concept of inflation purchasing power risk. So it was more simple, nothing to be very thorough into it. It is just about how your purchasing power, what is the risk associated with your purchasing power, particularly the risk of inflation. Now, one of the most and highly discussed topic is default risk. Okay, so what is actually default risk? Default risk is actually nothing. In simple way, you have taken loan from someone and you are not paying it back due to certain condition, you will be called as defaulted on the loan. Now let's read this text. Default risk, also known as credit risk, is a major concern for investors in bonds. It refers to the possibility that the issuer of a bond, it could be government, it could be corporate companies, or it could be individual also, they will fail to fulfill its obligations, meaning you will not be in a situation to pay the interest, or you will not be able to pay the principal amount as well. Okay, so this is called that you are going to be defaulted on the bond. See this cartoon, what is it saying? Not paying my credit card debt. Gonna default to show them all how serious about my finance. Okay, so it is like you're not in a situation to pay the interest or the principal amount on the bond or the loan you have taken. So it is called default risk. The risk that you will get defaulted on the amount you have borrowed from me. This is called default risk. Just remember this. Okay. Here's the breakdown of default risk. First is bond issuers borrow money. Okay. Meaning when you buy a bond, you are essentially lending the money to the person who is borrowing. Okay. The bond represents a debt obligation with a promise to repay the principal amount borrowed along with interest at specified intervals. Definitely, they make this promise and all. But what will happen if issuer experiences financial difficulties due to multiple reasons and becomes unable to meet its debt obligation? It might default on the bonds. This means you might not recover all or any of the expected payments. This is thing, and this becomes the default scenario. Let's see what is happening in practical world. So I just made a document about the current situation going on in US and all. So see what is happening here. In 2022, 2023, what was happening? Interest rate hike and bond sell off. Okay. In 20, what is the background of this case? In 2021, the US federal government kept the interest rate near zero to stimulate the economy during the COVID-19 pandemic. Okay, when pandemic was happening actually, so they wanted to take more loan and just to boost the economy. Okay, so this led to a sustained period of low bond yields. The scenario was in 2022, the Fed began raising the interest rate to combat rising inflation. So this signaled a significant shift in the monetary policy. Once they kept the interest rate near zero. Now they suddenly started increasing the interest rate. So this kind of because the inflation was so high and they wanted to combat it. Okay, what happened on the bonds? As interest rates rose, existing bonds with lower fixed coupon rates become less attractive to investors. Obviously, because investor could now buy new bonds offering a higher return in line with the current interest rate environment. What will happen to the bond price? From the very first chapter, we know the shift in investor preference triggered a sell off in the bond market. As investors dumped older bonds, their prices fell because they were not interested in older bonds, and anyway, it is losing its value. The longer the maturity of the bond, the greater the price decline it experienced due to duration concept we studied the last time. Okay, what happened later on? The bond sell-off continued throughout 2023 as the Fed implemented a series of rate hikes. While some investors held on to their bonds until maturity, others sold at a loss to take advantage of newer, higher yielding options. This highlights the risk associated with bond price volatility, even though bonds are generally considered safer investment compared to stocks. So this covers both the bond price volatility as well as how it may. Now you may ask the question how it may lead to default thing and all. So to see that, let's just see another slide. This here I have taken certain newspaper headlines right now. What is going on in the economy? See the first time corporate bankruptcies and defaults are surging. Here's why. If you see the just for this headline, I took key points also. See the first point. Corporate defaults rose last month with 41 in the US so far this year. That's more than double the same period last year, according to Moody's Investor Service. Why it is happening? Because companies are defaulting on their on their debt due to uncertain economic conditions and heavy debt loads. High interest rates have made it difficult to refinance as debt is more expensive now. The number of bankruptcy filing in the US this year has also sharply risen to levels not seen since 2010. Now you can imagine the situation. 2010 was the situation when US was recovering from the global financial crisis of 2008, and the situation is more difficult now. They are funding you, like they are providing certain help to Ukraine also in the war and all. They are raising lot of loan and all, and it is becoming difficult also for them. It's not the condition of US only. Even this headline also about European private loan market falters as corporate credit stress mounts. Even the situation is becoming that difficult in European economies. Also, another case of US is that elevated interest rates are pushing US corporate bonds into default. And the situation is not different for India also. Indian consumer borrowing surges rising, raising fears of default. I'm pretty sure many of you, please tell me at least one or two, mm, generally might have got so many calls, sir, take credit card minimum, or sir, take loan. We are offering you personal loan and all that very interesting uh, interest rate and all. How many of you have got? Like, I'm pretty sure many of you might have got. Anyone can just say, yes, I got and all. So many calls regarding credit card and all. Didn't you guys get? Or at least loan? Hey, yes or no? If no, then it's also okay. Maybe you are below
No,
18.
sir.
Oh, you did not get a? I get a note.
No.
Maybe once you start putting taking your civil score and all, you may get. But generally nowadays they are offering a lot of schemes that take loan, take this credit card, take this, take that. And what is happening due to this? Okay, we generally have a tendency, we see birds in the hand. There's a theory called birds in the hand, but why I'm using in this context is called, okay, I'm getting 1 lakh rupees or 5 lakh rupees. So your mind gets start tempting and you start finding use of also that money, whether you need it or not. That's how we call it credit card debt trapped also. So credit card, I always called a trap because once you buy a credit card, once you take a credit card, it is very difficult to get rid of it. You will have constantly something or other to spend on. You will always be tempted to buying something or spending on something, and that's how your habits go bad. So I remember once recently I just got rid of one or two card. I remember when I started using credit card, I was also like other person. You guys don't know how to use it in a mature way and all. I will use it, but you won't believe there was not a single month where I did not pay the credit card bill. Something or other will keep always coming, and your subconscious mind will always tell you, okay, now you can do because you have money. But suppose you don't have credit card, you will postpone that purchasing habit of you. You may say, okay, at the end of month, you will get your salary and you will try to buy. Or at least if you have cash in your account, either you will try to buy from that, or if you don't have cash, you will wait for some time. And that's how you delay it. There's a theory, I think, called it. There's a theory where you delay this payment, and what will happen eventually? There are situations you may not need to buy it also. It's like you are going to market and you see something, then only you get tempted to buy. Suppose you don't go to market, or suppose you say today I'm not in a mood. Suppose that's how it happens. No, if you go thirsty into a market, you will. There are high chances either you will have mango shake or you will have cold drink, and you will find cold drink much better. But suppose you drink a water at home and you go to the market, you may not like it. You may avoid also buying cold drink at all. So that's how it happens. So that's how consumers started borrowing more. They started. There are people who are no their income is 50,000, but they have EMIs of 40,000, but 10,000 he has to run the entire home. 1 month you have spent is okay, but your 40,000 is blocked now. Every month you have to pay that 40,000 per month. Otherwise, they will charge you 38% of the interest rate or 36% of the interest rate, or I'm not. There could be a penalty also and all. So you have to be very careful when it comes to taking loan and how to use it, how productively you can use it and all. That is another situation. So just guys, we will take 5 minutes break here. I'll just go. My throat is dry now. I'll just go and get some water. You also guys
Sure.
take 5 minutes break. Yeah, tell me, Vamna.
Sure, sir.
Okay, okay. So I'm just keeping you guys on mute. I'll meet now 8 6 12, around 6:18 or 6:19. I'll come back. Okay, fine. Thank you. Okay, guys, welcome back. So, what were we discussing? Hmm. So we were seeing this situation, what is happening. So even it's not a surprise actually. You just go if you just see what is happening. The world is full of negative news nowadays. Okay, you just see and it's a topic you want to see the default on. Suppose you are not interested in corporate loans. See the news. Jayaprakash Associate defaults on 4,258 crore loans. Future consumer defaults on this much loan. Chinese, this is the one of the major rising concern nowadays. China is showing so much default rate. So the default rate is very heavy in China actually, or high in China. Okay. Then you have this US already we have discussed. Byju's you have seen. Loan defaults now part of business model. See, this you guys must read. Even I read. You guys must read this article definitely. Okay. Now RBI is providing certain guidelines because people are deliberately going for default, willful default we call it. Okay. Then we have energy companies also on defaults. Okay, personal default. So many loans. See, and you see that within 6 7 months these are all the news are. So that is a market situation actually now. So before you go and invest into a bond and all, you have to be careful with the rating. You have to see what is happening with the company, how company is doing and all. So all these factors you should consider before you invest and you you step into the debt market and all. Now what would be the consequences of default? First of all, you will definitely lose your principal, the amount you have invested there. Worst case scenario, actually, that you may lose your entire principal also because you say sometimes bonds are offering the fixed amount of coupon rate and the fixed principal. And if the company go on a default or company go to bankruptcy and all, you may not be able to get your investment back. Generally, you will get the priority. But what if the assets are not sufficient to pay your principal? In that case, either you lose the partial value or partial amount of your investment, or you may lose the entire amount also if the company doesn't have sufficient resources to pay your debt. Okay. By the way, am I audible like after break?
Yes, so you are audible.
Okay, okay. Or you will miss your interest payments also. Okay. But why it happens? Why generally sometimes we say why it is happening? It happens sometimes so many reasons. You see in the picture also what is happening with federal debt. Okay. So what it happens? Because so many ongoing situation is going on. The first condition is the credit worthiness of the issuer. Bond generally which are issued by the governments and all are generally they think they are the safest bond, and that's why we call it the default free bond, or this bond will not get default. Okay, they are less risky actually, but it is not the case. That day I discussed a case of Russia also, that how Russia went on a default on its two of its euro bonds also, because that was but extraordinary situation because Russia had so much sanctions. They wanted to pay actually. They wanted to pay that amount, but since there was sanction on their account, they could not release that fund and they went on default. They got some period also. Like okay, within 1 month you can pay again. But what was the situation? They could not pay again because the same condition was there. Russia-Ukraine war was going on, and people they were not in a situation to pay that. Okay, so the what happens in credit worthiness? Generally, credit rating agencies provide some credit ratings like AAA rating or AA rating or A rating or triple B rated, which actually indicate the financial health of a company also. Okay, so triple A rated companies are doing very well. Their bonds are a bit safe. You can go ahead. That's why their interest is also low because they're compensating it with the risk-free property of their bonds. Similarly, there are a company who the rating is triple B. It is like okay, they are in a situation where they can pay, but the default rate compared to the company who's having triple A rating with their instruments are higher. So you have to be careful. That's why they pay higher loan also. Same thing happened with us also, no, individually. If your CIBIL score is high, you will get a loan on like less interest rate. Okay, but if your a CIBIL score is low, there would be people who would be willing to pay you loan, to provide you loan, but they will charge higher interest rate. Okay, same thing happens in the context of companies also. Okay, so the credit worthiness of the company is low, they will definitely go for the higher interest rate loan, and eventually they may get default also because the business may not do that well and they may not be in a situation to pay its loan. Okay. Then second important factor is economic condition, which we all are very familiar about, like what is happening in US, across the world actually, like COVID-19 pandemic happened, then Russia-Ukraine war happened, then your Middle East crisis is happening right now. Now it is bit settled, and then you have some other condition, like it's not negative condition. It could be economic volatility may happen because of political issues also. Like India is going to face election. We don't know what will happen. What would be the result of election? Who will win? Who will lose? What is at stake? And all so many things are there. Then it could be because of social issues. There are riots, there are protests and all. So there are multiple factors which may affect overall economy in general and which may affect the like debt obligation of the company. So for example, there were certain companies during COVID-19 pandemic, like especially small manufacturing and all, they could not function well. They could not do any revenue and all, and they had to pay their charge for the fixed asset continuously, their depreciation and all. Eventually, the business got stopped completely, and they were not in a position to pay its debt at all. Okay, same. So many security companies went on bankruptcy and all for that. So many manufacturing companies went on bankruptcies and all. So this happens sometimes. Okay, what is happening in the overall economy and how it is affecting. So suppose a company who is operating in Israel or operating in this thing Iran and all, but their entire supply chain depends upon the particular route offered by Iran or Israel, and due to war, that route is blocked. How long they will survive because they don't know how long that war will go on. That could be a situation, it will go for 1 year, but you cannot wait for 1 year. The company will eventually go for default unless it is a very big company where everyone is willing to rescue the company and all. Okay, so this kind of economic conditions, social, political, economical, may affect the overall probability of default or the default condition of a companies and how they will meet to their financial obligations. Okay. Now, how do you manage the default risk? So sometimes we say, okay, you should have a diversification. Your property should be invested not only into the IT companies, you should consider pharma industries also. That's what happened in COVID-19 also. The shares of pharma companies were actually rising faster than the share of manufacturing companies and all because people were investing into that. The revenue was high. Even dollar demand was very high. So much this revenue was being generated by these pharma companies at all that time, but there was firms which were losing a lot also at the same time. That's why they say of Sensex eventually was increasing. It was not increasing just because of some magic happened in COVID pandemic. Companies were doing well. It was happening because some companies revenue was increasing despite anything, and overall Sensex was increasing that time. Okay, so you should have a diversification in the sense you should not put all the potatoes in one bowl. You should have you should keep 3 4 bowls where you can keep your potato even in a glass or in a made of brass, made of iron, made of this thing. So when it fell down, it will not, you will not lose the entire potato. Okay, just a simple example I'm trying to tell you. You also should focus on the credit quality of the firms. Like you want to invest, if you are risk averse investors, you want to invest in certain bonds having higher credit ratings. Okay. As I said, these types of bonds but may offer you lower interest rate, but you will be in a safer hands. Okay. If the ratings are high, companies are doing well, your money would be safe. And especially middle class families who have like very hard earned money and that neck to neck kind of situation, they cannot afford playing around with their money, investing into very risky bonds and all. Okay. Then you have to aim for the long term. Okay. If you are investing for the long term, in that situation, you will be safe. So for example, if you are holding a bond till its maturity, it can reduce default. Is why? Because if issuer experiences temporary financial difficulty, they might have time to recover. and fulfill their obligation by the maturity date. It happened with many companies. I think it happened with Yes Bank also. There was a time when Yes Bank we got scared. People started pulling out their money, but eventually Yes Bank recovered from this. No, it may not happen with every company and all, but if you give them more time and company has potential to come back, definitely the probability will be little bit less. Okay, you may get recovery of your investment amount. Now, how do you measure this credit risk? Sorry, this default risk. So there are many ways of measuring this risk. The first thing is credit rating. So this is the most common approach as I discussed. Based on credit rating, you may assume how the company is doing. As I said, there are different ways of rating AAA, triple B, not C, BB, B plus, A plus, and all. You can actually have some sense. Okay, this company is offering triple B rating and all. I know some fundamentals about of these companies. This company may get on default and I may lose my value. Okay. So you have some, you can make some guess or something like, okay, this will not be the case or this will be the case. But there are certain limitations because this is not foolproof and can sometimes lag behind changes in an issuer financial health. They also apply to broad categories and default risk of a specific bond within a rating category can also vary. Other thing also sometimes they may not rely. I should not say reliable, but sometimes it happens the actual situation is different, but inside something is different. So mostly they are correct, but at least they can give you an indicator that whether you what is the situation of that company, because based on that rating, you can do your own research as well. What is the situation of the company? What are the financial statements are telling about the company? How long that company has been into the market? Whether you have what is the people opinion about that company and all. So you can see the potential of that company in the long term. Second thing is yield to maturity. This is also can be an indicator. Like we discussed till now so many times, yield to maturity, the market rate of return and interest rate. So sometimes what happens, the company with having higher default rates, they will definitely offer higher yields compared to other companies in the picture. So you can guess actually, okay, this company is offering higher yield, meaning the company's um, default probability is high, or in the sense the company's risk is there higher, and maybe that's why rating is low, or maybe that's why investors are a bit doubtful about this company. They want to invest in their company, but they want to get compensated for investing into high risky bonds and all. So they will require higher premium on that investment. This company will offer higher yield, and you can have a sense or you can guess, okay, what is going on there. But actually, it also has a limitation. It is just a it reflects it may reflect various risks and just not default risk. It could be because of ongoing situation in the market. It could be because of market condition in general, or it could be sometimes liquidity. It could be some type of global volatility. It could be sometimes given other factors, the oil price situation in the economy, or the particular product or the demand and so on. Like suppose now MDH and all, what is happening with these companies? There are certain sanctions from other economies that they might have certain chemicals in their spices which are causing cancer thing and all. So government has also put some scrutiny and all. And today I was reading it may affect the significant amount of Indian export if that bans happen. If European economies, European Union and US and other economies will start putting ban on the spices, India's total contribution is around 12% of world in exporting the spices to the world. So imagine the difficult situation it would be for the economy as a whole. But at the same time, it could be temporary. Maybe they may take certain corrective actions. Masala, whatever they are sending, maybe in the better quality. Food authority may give them nodal, and then they can again gain their strength. So that's how it happens. Like, but right now, what will happen if MDH is offering bonds and all, given the market condition and all, people may not be interested in investing these securities because they may think you don't know what will happen. Maybe they will go completely on ban. Their revenue model will change. They will not be able to earn that much. If they are not able to earn that much, how will they pay? Okay, so this for temporarily, they may offer higher yield to maturity. So it's not just default risk. It could be based on current ongoing situation or market condition, what is happening right now in the market in general. Now you have another important point, which is financial ratios. So financial ratio also helps you in analyzing the financial situation of a company. Like there could be certain, particularly most importantly, debt to equity ratio or interest coverage ratio. Debt to equity ratio tells you how much debt is there as compared to equity. If higher the debt compared to equity, higher the would be the default probability, because it indicates that company is running heavily on leverage, heavily on the debt or the loan. And if something happens, company may go on a default. Okay, interest coverage ratio measures how much you have operating profit or earning before interest and tax compared to your interest you are going to pay on the fixed investment. And that higher the EBIT you have, it means you are in a better position to pay the debt of the pay the interest amount and all. And company may get a one signal. Okay, oh sorry, investor may get a signal. Okay, firm is having sufficient resources to pay its debt. They are paying on time, and then definitely the company's potential is high. It happens with us also. No? When we just keep paying our EMIs on time and all, our CIBIL score will improve definitely, because those who are providing loan, they assume, okay, these people are good. They haven't missed a single EMIs on time. Maybe next time they are a potential and high valued customer, we may offer them slightly lower interest rate as well. Okay, there are could be profitability ratios also, like what is the profitable situation for the firms and all going on, what is the gross profit and all. And this give you the indicator, but profit is not just the only indicator, because there could be different situation year to year or time to time. Again, it could depend, it could depend upon the market condition and all. So the profit could be low, and this will not give you the true picture. Okay, so you have to be very careful when you are analyzing it. That's what the limitation is giving, that financial ratios requires some financial analysis expertise and might not always predict future defaults. Okay, so you have to be very careful when you are measuring the financial health of a company based on financial ratios. Now, you have market signals. Market signal says that different news in the market, or what is happening right now or currently in the market, or about the issue or what is the situation there, they actually tells you a hell lot of story about the company. Okay, it can help you in identifying the what are the potential risk and with the firm that could lead to default. Okay, right now you may think, okay, there are so many bans were on the Paytm and all. Paytm may go on default and all. I don't know what will happen. So this kind of situation, what is happening in the market about these firms, what are the news and all. And now the real news came about Adani, news came about Ambani, news came about Wipro, whatever, how many companies you may see, if news are coming, you generally try to predict the future of the company. Okay, this may happen. Maybe food, so for example, in MDH case also, people are doubtful what will happen if people stop buying their masala. Suppose now everyone start becoming aware about the health things and all, and they are not bringing these masalas into their kitchen. What will happen? It will hit very hard to this the masala company's revenue and all. Okay, so this could be a situation then where you try to get certain signals from the market and make your decision about the firm and what about their potential future earning. Okay. Oh god, continuously talking throat is, I don't know what it will say. Okay, now we will discuss about this default probability model. They are more advanced models. Okay, they put a lot of calculation, statistical measures, then take a lot of simulations, advanced methodologies, maths and all, and they try to come up with certain models that use like complex algorithms, historical data, and you try to do nowadays people are more into this machine learning, artificial intelligence. They try to run the data, principal component analysis. So many things are there, that complex models are there nowadays. That's why there are high demand for the data scientist, data investor, because what can you get out of the data? What can you bring out of the data? Okay, so you might have seen, no, this is what is happening with YouTube, what is happening with Netflix and all. You just start seeing a video of a particular type. Definitely, next time you will get all this video. You start seeing news, positive news about a particular party. all the shorts, reel, news, YouTube, whatever, everything you will get about that party, and it must be telling about your positives also. You start watching small, like short clips on cricket news and all something. Your every third video would be about this thing, cricket news and all. It happens with Instagram, it happens with Facebook and all. And that's how the advanced models are coming, and they try to predict the behavior of an investors. It happens in Netflix also. You put suppose this you start watching Narnia kind of movie or Lords of the Ring kind of movie or like Harry Potter and all the fantasy related movies will be there next day in your list. Okay, that's why sometimes when you open an account in the Netflix also, they ask like 4 to 5 priorities. You want to watch Hindi, English. Okay, in English also you want to watch action, animation, thriller, horror, and there are so many genre, and you want to see. Accordingly, they will come up with certain movies which you may like. This will help you also, but this is sometimes very difficult also. Like for example, nowadays sometimes I say privacy is becoming very difficult. You start talking about a particular thing about in front of your mobile, maybe in coming time you may get some offer from a particular company, we are selling this product and all. So there are so many advanced models and all are coming, coming to this fixed income and all, which may help you to understand what is happening with the company situation, their revenue things and all, and they start predicting what will happen in future. They use advanced regression things and all, logistic regression and all, and then we'll try to come up and predict certain models what will happen this company in future. Okay, so there are certain terms when we about this when we talk about what were we discussing about the default probability models. So there are certain terminologies you need to understand revolving around default probability before you go into the numerical assumptions and all. So these terminologies you have to be very careful and you have to learn, and then they will help you in understanding daily news also, like what is happening, what all these things called, and they are very highly used terms in the context of uh, default probability and all. So first is itself is probability of default. This is the likelihood that a borrower will fail to meet their debt obligation over a specific time horizon. Okay, typically in 1 year. Like in 1 year, what is the probability or likelihood that a borrower will not pay the debt? Okay. Second is distance to default. This is a structure model based measure that indicates how far a company's asset value is from the default point expressed in terms of number of standard deviation. Okay. Then thing is your credit score, which we have discussed so many times. The numerical representation of a borrower's credit worthiness based on various factors such as payment history, outstanding debt, credit utilization. Credit is okay. So like the civil score is also combination of all these things. Okay. And it also you openly used as inputs in credit scoring models to estimate default probability. Any questions so far? No question. Okay. And I'll keep talking. Hmm. Where were we? Okay. Now you have ratings. Ratings we have already discussed a lot. Then you have exposure at default. What is exposure at default? This is the actual outstanding amount or the portion of the amount which is exposed to the default at the time of default. Okay. The outstanding amount owned by a borrower at the time of default. So for example, you have invested 1 lakh, so the exposure of default would be 1 lakh. So suppose the person goes on default. So your entire 1 lakh may be your entire exposure would be 1 lakh because you may lose entire 1 lakh. Okay. But what is at the same time expected loss? Expected loss is the product of probability of default, loss given default, and exposure at default, and represent the expected credit loss for a given exposure. So actually, this is the final you will try to come up with. What is your actually expected loss given the default probability, given the loss given default, given the exposure at default. Then there is a concept called hazard rate. Hazard rate, what is the hazard rate? This is the instantaneous probability of default at a point at a given point in time, commonly used in survival analysis. So what is this actually? It is we sometimes called given a condition that companies till today has never defaulted on any loans, but still what is the probability that this company may go default in future? Okay, given the condition that companies has a zero default rate, but still if it goes on a default, what is the probability for that? That is sometimes we called it hazard rate. Okay, then we have default correlation. What happens in default correlation? It may happen that one default may be correlated with other defaults also in the company. Okay, so suppose a company is getting default on a bond A, how it is correlated that it may lead to the default of a bond B also. Okay, and this is also very important things to consider in the uh, mind. So, for example, a company who is more into cocoa go on to default. There are a company who is into mainly in coffee business may also go on default. Okay, so the company who is into milk product go on a default. Then a company who is actually making a milk product and all may also go on a default. Okay, so sometimes how they are correlated that one default may lead to other default, and this is called and how they go on a default together. That kind of relation when we measure it, it's called default correlation. Okay. Lastly, we have loss given default. This is the expected loss that a lender will incur if a borrower defaults, usually expressed as a percentage of exposure of default. Suppose there is a default, what would be the loss actually you will incur? Actual loss, what would be your loss there? Okay, so these are some terminology. Read it again and again. Sometimes they might be confusing, or okay, it looks like exposure at default, same to loss given default. But if you read it little bit more carefully and all, you will understand the differences. So read this carefully. You will have better understanding of all these things. Okay, now
So,
just take a yes.
sir, uh, आप हाँ, डिस्टेंस इन डिफॉल्ट आप ये रिपीट करेंगे एक एग्जांपल के साथ?
Very distant to differ. This is a structure model based measure that indicates how far a company asset value is from the default point expressed in terms of number of. So suppose the mean probability of defaulting on a bond is 5%. Okay, in general, in the in general with the similar companies in the economy, the default probability or the mean probability is 5%. But the company which you are measuring with may have like 0% or 1%, or maybe the deviation we calculated the deviation also no, maybe the standard deviation suppose you calculated is 5. So you may say that the company has is 5 standard deviation away from the mean, meaning that that company is far little bit away from actually going into the default zone. So you try to calculate how far a firm from going into a default. You see what is happening in future, how it is going enter into the default zone and all. That we call sometimes distance to default. How much distance is there from the default? Okay, just go with the terminology.
Okay. So it does take probability of default into consideration.
Yes, it takes multiple factors into account. It calculate the
Okay.
probability of default and then try to calculate how standard deviation it is from away and all. So it takes all the things into account and then calculate.
Okay.
Okay. Now let's see just one this example. A very simple example. That's why in bold in italic I gave. This is a simplified example for illustrative purpose only. Actual default risk models are much more complex and use a wider range of factor and data. They're also often proprietary and do not publicly available. So I just made a simple model from my side, try to make you understand how these different scenario you can use to understand default probability. Okay, so for example, we are considering a corporate bond issued by company XYZ. We want to estimate the default risk using a basic model. So model components is first of all, you have historical default rates. Okay. We can gather historical data on default rates for corporate bonds with similar characteristics, industry, credit rating, etc. over a specified period. For 5 years, you can get historical data on multiple factors. Then you can calculate the company specific factor. As we said, company specific factor could be ratio, like you took debt to equity ratio is 2.5%, interest coverage ratio is 4. Okay. Once you have taken this two component, you can do the simple calculation. First, what is the base default rate? See the historical default rate in the corporate bonds with a similar credit rating as company XYZ bond. And let's assume a base default rate is 1% is hypothetical. You may get this data from like what is the default rate in the company and all through different databases and all. They keep publishing about what is the ongoing default rate for a particular industry in the economy. Okay. But there are certain situations that 1% you have base default rate. Based on this base default rate, you want to adjust for the company leverage. Now there are certain things with the company also. You want to adjust the rate for that, and you want to see what is there for your company, particularly how you calculate the default probability for your particular company. First, to take high debt levels, okay, indicated by high debt to equity ratio. It can also increase your default risk, obviously. So what we will do, we will introduce a factor based on debt to equity ratio. This factor will actually try to adjust the base rate according to your debt to equity ratio. For example, there is a leverage adjustment factor 1 point, say the formula is debt to equity ratio divided by industry average debt to equity ratio. That also either you can calculate by yourself using certain models, or you may get it on the publicly available information. Once you have this industry average debt to equity ratio for comparison might be found through financial databases or research report. Let's assume, for example, it is 1.5%. Okay. Once you have this 1.5, you can calculate this leverage adjustment factor by, as the formula at 2.5 divided by 1.5, it is 1.67. Okay. Then you have adjust, but you took interest coverage ratio into account also. So strong interest coverage ratio suggests a company has sufficient income to cover its interest payment, as I said. So it reduces the default risk. Again, we can introduce a factor based on this interest coverage ratio. And how will we do? There's a formula called 1 divided by interest coverage ratio. So 1 divided by your interest coverage ratio was 4. So your 0.25 is the second factor for your interest coverage. Third, you take the now you calculate the default risk. Okay. So what will you do to calculate the default risk? You multiply the base default rate by the leverage adjustment factor and then multiply by the interest coverage adjustment factor. If you had taken other factors also, you will take that also into account. Now, what is your adjusted default risk is base default rate multiplied by leverage adjustment factor multiplied by interest coverage adjustment factor. And then you calculate it is 0.42%. So we generally measure it compared to the base value. So base was 1%, it is 0.42% higher, like 1.42%. So in that situation, the default rate is higher by 0.42%, meaning that the bond has a slightly higher possibility of getting on the default. Okay. So this is a very simple example. That's how one way to calculate this when you take certain methods into account. There's another things also which is called probability of default. This actually we will discuss in the next class, and this only the concept, like 4 or 5 slides are there, but you need little bit to pay attention. Right now we all are exhausted. So this we will discuss in the next class. Till here I have finished this default risk in the simple manner. In the next class we will discuss about probability of default, how to calculate probability of default. The first half would be cover this unit over, and the second half we will cover uh, the last unit of this chapter. Okay, and with that we will close this fixed income securities course. There would be a revision class that I will ask the concerned faculty if I can give it as offline. So I will give it as offline, and we'll meet you guys there. Okay, so with this I'm closing for today's session, and if any question, please let me know.
So
Yes.
whole syllabus is covered?
Yeah, almost. This is the third unit. One unit Manisha ma'am has covered. I think someone told me in the last class, and there would be one more unit left. I will try to either cover it in one class or 2 classes. With that, your course would be over.
सर तो उसके बाद आप ये पीपीटी शेयर करोगे हमारे साथ?
हाँ, definitely PPT आपकी.
Okay.
I made with full. So I made this PPT in such a way you guys can easily understand all these things. I covered comprehensively all the topics. Okay, so use it effectively. I'll remove all the images, but because images are always subject to copyright, so I will remove all the images and will share the PPT after refining it to you with you guys. Okay.
Okay, thank you, sir.
Thank you so much, Thank you so much, everyone. Please take care. I will take one more class. Maybe we'll try to cover up the course, and then I'll try to come up in person to take your revision class. Then we will meet in person. Okay.
सर
Okay, sir.
हाँ जी हिमांशु जी.
सर ये पिछली क्लास में कोई कह रहा था मनीषा मैम ने 8th चैप्टर कवर करा है, स्ट्रक्चर
हाँ जो भी है मेरे को वो भावना, you have my mail ID, you please tell me the exact unit and the topics he has covered, so that I will
Okay, I
make
will
my,
share.
please do it today only, because I will make my next PPT accordingly.
Okay, I will share.
Thank you so much, Bhavna. Thank you, Mansu. Thank you for bringing this question. Okay, guys, please carry
Okay.
on, and good night. Have a nice. Okay, bye.